Let's get to today's action. The S&P 500 and the Nasdaq jumped to record highs, as did Apple, Alphabet, and Microsoft, as the latest inflation report showed progress on prices. The Fed, though, signaling just one rate cut in 2024. And joining us now is David Zervos, Jefferies chief market strategist and now a CNBC contributor, and Kristina Hooper, Invesco chief global market strategist. Welcome to you both. David, one cut this year, which shouldn't be a surprise, but admitting it, I thought that the market might take it differently once the Fed actually admitted this. The market seems, at least initially, to have taken it pretty well. Why is that?
I think the market is taken all of the changes that we've seen in rate expectations pretty well all year. We had a point at the beginning of the year where we were forecasting 6 or 7 rate cuts, and then we kept whittling them out, and we got down to now 1, and the S&P just keeps going up because I think they have confidence that the Fed is going to get to where they want to get to, which is ultimately their 2% inflation target. It may take a little longer, but the process of getting to an anchored inflation expectation outcome and the Fed doing what they set out to do it's in train. And I think that's what he told you today. He was very positive on today's inflation print. He was very positive on the progress that's been made. And he's just telling you it's going to take a little longer. The bond market has to readjust the curve a little bit. We saw a few of the front month contracts in the interest rate futures not trade as well as the back months. But that's just a little bit of baloney slicing. It's nothing specific. The 10-year had a good response to the data and a decent response to Powell. And I think in general, it was almost like what Mike Santoli said at the end of in the lead into our segment. It's that the Fed can act if they need to. The Fed is there for you if you need it. And that's been a theme of ours all year. The Fed put structure is really back. They've accomplished what they wanted to accomplish. It might take them a little bit longer. But if things get messy, John, then they're going to come in and they're going to do something, and they're ready to act. And the equity market knows that. That's why it doesn't go down.
So in a sense, then, Kristina, is this a return of a reassertion, I should say, of the soft landing narrative, especially in the context of that cooler CPI print this morning, that maybe this is all going to sort of work out and we don't have to freak out too much and equities can be okay?
I think that's right. Now, one thing that was unusual about today's dot plot was the increase in expectations around core PCE. So if we look at the December 23 dot plot, it was at 2.4%, the end of 24. Then in the March dot plot, it moved up to 2.6%, and now core PCE is anticipated to be at 2.8%, which is where we are now. So that suggests no progress on inflation for the rest of this year, but still penciling in one rate cut. So what that says to me is that the Fed could very well bump that up to 2 rate cuts if we do see some disinflationary progress. So I think that this is a very positive scenario. I think Jay Powell was very measured and thoughtful in the press conference. And so I think David's right that people walked away and felt very comfortable with where the Fed is and what could potentially happen. There is a lot of optionality.